Stocks had a boring week, at least from an S&P 500 perspective, ending the week almost unchanged. Much different from the developments in the crypto space, which was once again shaken up by a new scandal as FTX, a leading crypto exchange, went under. In that downfall, another major player in the crypto space, crypto lender Genesis, got in trouble as well and had to halt all withdrawals from its platform. So anything but boring in that corner of the markets. Hello Sector Watchers, welcome to the show. This is the 153rd episode of Sector Spotlight for Tuesday the 22nd of November, and I'm recording it on Monday the 21st after the close of the US markets. My name is Julius Kempenaer and I am presenting to you from Amsterdam in the Netherlands. The main segment of the show for this week is an in-depth look at what's going on inside the consumer discretionary sector and some of the individual stocks. Obviously, Amazon and Tesla play a big role as they are dragging the sector lower. But on the other hand, there are plenty of opportunities as well. Ladies and gentlemen, this is Sector Spotlight. I'm going to keep the asset allocation segment very short this week because for the major asset classes, picture is still pretty much the same, not much has changed. But if you look at the RRG for the asset classes that we track here in Sector Spotlight, the weeklies on the left, the dailies on the right, I think you'll agree with me that there is one asset class that stands out, and that's Bitcoin, or more broadly, crypto. And that is a reflection of what's going on since last week. Again, in the crypto space with FTX, all the problems of FTX, with Genesis, a lot of havoc, a lot of trouble inside the crypto world, and it's got its reflection on Bitcoin. If you see the tail of the weekly, we already saw that starting to bend over last week. That is continuing, and if you see what's going on over the last 5 trading days with Bitcoin, you can see that that's actually pushing deeper into that lagging quadrant, underscoring the current weakness in Bitcoin. And if I bring that to a price chart, that's the only price chart of asset classes that I want to show you this week. We already talked about the break below 18,000 on the price chart, and the break of divergence in the RSI, which is all kind of supporting more weakness ahead. Actually, what we see here now, because it was that break below 18K is confirmed right now. We've already got like 2.5 weeks trading well below 18K, so that is a done deal. If you now look at the daily, then you can see that after that first break, Bitcoin went into a small consolidation, and you could look at this as a kind of a wedge type pattern. I think it's too short for a triangle, but it looks like a pennant. Sorry, not a wedge, a pennant I mean. So a pennant is usually, when it comes after a big drop, a pennant is a very weak pattern, and it looks as if we're now leaving that pennant to the downside, which is basically confirming and triggering a further move down. Final confirmation is when we take out that low of the base of that pattern, which is around 15,500 US dollars. So when we see crypto breaking below 15.5, I think we've got to be prepared for another move down, and the target, as you know, as we discussed last week, is around 12.5, 13,000. By the way, on the dashboard, on your dashboard in StockCharts, you will mostly open it up with equities, but there is also a box for crypto, which gives you a very quick overview of what's going on in the crypto world on that day. And you can see that this is today. Crypto again, or Bitcoin again, lost 2.9%, and the majority of these coins actually lost. Got a few winners here, but the majority is moving lower. Sector rotation for US sectors is currently sending us some mixed signals between weeklies and dailies. We've got the weeklies on the left and the dailies on the right. And I think that the main picture, the main takeaway is still intact. And there are a few nuances that we can make. And what you can see is that quite a few of the daily rotations are moving opposite of what we see on the weekly tails, of those of the same sector. So we're kind of in a intermediate type of, depending on the trend, recovery or correction, whatever you want to call it, like an intermediate move. So if we look at the main moves, then I think that the ones that are standing out, at least to me, are, for example, materials. That is a very nice rotation, moving almost in a straight line towards the leading quadrant. Also, the industrial sector, moving really nicely into that strong RRG heading. Quite similar for consumer staples. It's coming out of the weakening quadrant and pushing back into leading. But on the other side, we have utilities, which is pushing rapidly into the lagging quadrant, which is, for me, the odd one out, because both healthcare and staples, the defensive group, is inside leading, and utilities is rapidly moving out of it. So something going on there that doesn't quite match. And we've got communication services, which is powering deeply into the lagging quadrant. And if you look at the daily, then you can see that the tail for communication services is moving in opposite direction. And some of the same you got for the ones that we have here. Utilities is actually confirming, but staples here is moving into lagging on the daily, where it is moving nicely into leading on the weekly. And you got industrials and materials rolling over. They are still on the right-hand side. They are still strong, but they are rolling over there while they are really strong here. So it's a bit of a mixed bag between all of those. Let me bring you a couple of interesting charts following these rotations. And the first one is actually materials. It is pushing against resistance, but I really like the way that relative strength is working its way higher towards the upper boundary of that range. And there is still some fuel left in the tank, as it seems. And if we look at industrials, then we have broken that falling trend line. We're now pushing against the previous high, which is around $100 for XLI, I have to say. And that breakout of the relative trend and the pickup of the RRG lines is obviously very confirming and very reassuring for more strength in the industrial sector. And then utilities, as I said, the relative strength broke. You can see the weakness in the RRG lines, but the current rally is pushing against that old support line that is now acting as resistance. So out of these three defensive sectors, utilities is quite clearly the weakest one of the three, and that is putting that whole narrative of defensive sectors leading the way, taking away some of its value. Although some of the cyclical stuff is still rotating strongly into the lagging quadrant, so it's still not a super bull market, but you can feel that under the hood there's a few things changing, and it can be resolved either way. It can be utilities moving back up and picking up relative strength again, and then we're all out defense again, or it can be healthcare and staples losing relative strength again. We've got to wait and see how that develops and how that situation resolves. And then finally, we've got the consumer staples sector. You can see that this is also breaking that falling trend line. There's a bit of upside there, and it's pushing against overhead resistance in the relative strength line, and you can see that the RRG lines are picking up again, and the fact that the green RS momentum line is now back above 100 translates into a rotation of XLP back into the leading quadrant on the RRG. As you know, it's a resumption of the already existing relative uptrend. You may have noticed that I have avoided talking about the consumer discretionary sector, which obviously is showing a very weak tail on the RRG. And the reason for that is that we're going to do a deep dive and dissect everything that's going on inside that consumer discretionary sector in the sector special segment that follows next. So for this occasion, I thought to zoom in on the consumer discretionary sector. Obviously, it's one of the more heavyweight sectors within the S&P 500. It used to be higher. It's currently at 10%. I believe it topped out around 12 or 13, and by that time it was at least the third, maybe even the second sector. Right now it's the fourth sector. But nevertheless, an important sector and an important influence on the performance of the S&P 500 as a whole. And when I looked at, sometimes I make the comparisons between the regular sectors, the cap-weighted sectors, and every now and then I take a look at the equal weight sectors. And most of the time you will see a similar rotation. They're obviously not exactly the same, but you will see rotations that are alike. And when you do that right now, and I've got the cap-weighted sectors on the left, that's the normal State Street Spider ETFs that represent all the sectors, and I've got the Invesco equal weight sector ETFs on the right. And if you would go, we're not going to do that right now, but if you would go through all the individual tails, you would see that the rotations are sort of similar. I mean, you just eyeball it. You can see energy on the top right. You can see utilities making that big move. Real estate is crawling a little bit upward. Communication services is moving the other way. Materials is inside improving and moving that way. So they're kind of technology curling up, curling up. There's one big differentiator between the two, and that's the consumer discretionary sector. If I highlight that sector in the cap weighted, you can see that it is a long tail, probably the longest tail currently on the plot for the cap weighted sectors. And if I highlight consumer discretionary on the right on the equal weight, you can see that it's actually a very short tail, and it's inside the leading quadrant. It's not the strongest tail, it's not at a super strong RRG heading, but it's moving to the right, losing a bit of momentum. It is a very short tail, which means that it's kind of stable at where it is right now. Compare that to the big move of XLY on the left, and you have an issue at hand that needs further investigation, explanation, if you wish. And I think we can all kind of guess what's going on here. Obviously, the consumer discretionary sector has both Amazon and Tesla in it, and these are heavyweights within that sector. So what I want to do right now is go into that sector, look at this sector rotation, look at the rotation of the individual stocks in that sector, find out what's going on, and then highlight a number of individual names to see, or basically to show that despite the fact that the sector as a whole, cap weighted, is actually looking terrible. Look at that sector rotation. That is a terrible rotation. But inside that sector, it's a big sector in terms of number of names in it. There are a few stocks, quite a few stocks actually, that are looking really, really nice. So if we dive into the members of that sector, and we start with, so here are all the members of the consumer discretionary sector against XLY, against the sector index. And you just eyeball it. In one glance, you can see that this, if you would look at this, like, hey, this is actually looking pretty good. Now remember, that sector is actually on a negative rotation versus the S&P 500. If we do this against $1, so we're now going to look at all the individual tails against $1, then you can see how spread out that sector is. There's quite a few that are on very weak red tails pushing further into the lagging quadrant, but I would argue that the majority of those tails is actually moving in a northeastern direction, moving to that top right or moving higher on that RS ratio scale. So this is a sector that's really divided if you start looking into the individual tails. And that makes it an interesting sector to trade in and to maybe find stock picks. But it's a perfect sector to play with the XLY ETF and individual holdings. So I'm not sure if you are able to short, or maybe you can trade options. But one of the things that immediately springs to my mind creating exposure to XLY is basically buying the XLY sector ETF and hedging out the holdings that are really weak, at least Amazon and Tesla. So what you then would do is you would actually buy the XLY, calculate how much of XLY is allocated to Amazon and Tesla, and then find some sort of a hedge in the terms of options or an outright short sale or whatever you can do in your account to hedge out that Amazon and Tesla risk, basically hedging XLY versus the negative elements in that sector. So here's the rotation versus $1. Let's go back to XLY. And what I've done is I actually went through all those tails and looked at the individual charts. Obviously, that's too much to do in half an hour, and it's pretty boring. It's basically doing your research work. But I've highlighted a few of the tails, a few of the individual stocks that I want to share with you. And I actually put those tails on a separate RRG. So basically, this RRG is a subset of this RRG. It's the same list. I've just highlighted a few of the tails of which I think, and by all means, these are not the only ones. There are quite a few more individual stocks that are actually looking pretty nice. But I thought about picking the bigger ones and the more familiar names and the heavyweights within the sector. So let's go. So obviously Amazon and Tesla super weak, and you can see the opposite rotations here. This picture is crystal clear. Get out of Amazon and Tesla if you're not out of that already, and look for allocations in one of those, in those, Hilton, HD, McDonald's, TJX, and Starbucks are the ones that I picked. And I want to go over these individual charts right now. So one of the things, sorry, I went too fast. So here is the price chart for XLY, and look at how that relative strength is dropping below that last low. That's a very negative signal. And see how the price of XLY is actually hovering above that 130 level. If 130 breaks in XLY, you can expect a lot of follow-through selling. That would be a really negative signal for XLY, and I wouldn't be surprised if that's going to happen, especially with this type of relative strength. If you compare that with the equal weight counterpart, which is RCD, which is then compared to RSP, which is the equal weight S&P, you can see, I didn't annotate it, but you can see how this RCD ETF bounced off that support level much stronger than XLY, and how that relative strength is actually holding up really nicely. So there is a big difference there. Again, if you want to play, you could play RCD versus XLY. That would also be a very nice play actually. So I've got to the individual stocks. Then first of all, the weak ones. So here's the price chart of Amazon. I'm sure you've all seen it, but let's just throw it out there once more, and especially focus on the weak relative strength. This is the weakest relative strength in the last 4 or 5 years. And then we broke below the previous low here. This one is on the way down, and the next support level is just above 80. Upside potential, I think, for now is limited to around 100, and that tail is speaking volumes. The second one is obviously Tesla, and this is a very interesting chart, because if you look at this long-term chart here, I think this qualifies as a major head and shoulders type reversal pattern. And if you just use the target calculation as it was presented by Edwards and McGee, they would say you gotta You're going to measure the height of the pattern, which in this case very roughly is 400 to 200. That would be 200 bucks. And you can project that below the breakout level. Now let's say that the breakout level is here. Let's be very generous. The breakout level is 225. That would put a target price for Tesla at $25 US. It's currently trading at 167. That's a bit overdone, maybe. I don't know. Maybe it's possible. I find it hard to make such calls. I'm not a type of guy that would make these type of goals. It would make headlines for sure, but I'm not looking after that. So what I usually do when the move is so big, I'd like to move to percentage moves. I think that is a more realistic approach. And if you calculate the percentage, then obviously that's about 50%. And if you project 50% from that breakout level, you're coming around 100, a little bit above 100, and you can see that there's a little cluster of support and resistance that goes back to 2020. So I think that's a more realistic target for Tesla at the moment, based on this price chart, based on that strong break in relative strength. And in a chart like this, it probably makes sense. I love logarithmic charts, but it's very hard to annotate them, especially with diagonal charts. But if we bring up the log chart for Tesla, then you can see that pattern actually making sense, and you can see that around 100 there is a little bit of support left. More outspoken would be $65 US if this all works out. But we can be very short that this is not a good looking chart. This is actually a very weak looking chart. And it looks as if there is much more downside to come for Tesla. And the upside is, in comparison with the downside, the upside potential is very limited. I would say it's limited to about $200 right now. Obviously, these two major stocks, major players within the consumer discretionary sector. Let's go to the better looking charts. Let's go to these green tails here. If you look at the first one, that's Home Depot. So Home Depot powering right into that leading quadrant. If you look at the relative strength, look at that power move above its resistance. That's breaking out, and it's on the verge of completing a very big double bottom formation on the price chart. Where are we going to draw that trigger? I would say it's around 317, 318 where we currently are, because this is just an intra-week high around 330, but it will be definitely some sort of resistance. So the first sign will be when we trigger 318, and then definitely when we go above 330, 332. That'll be the sign for Home Depot to move higher, but it is one of the stronger stocks within that sector, without a doubt. Second one, even better, breaking to new highs. That's McDonald's. And look at this relative strength breakout. That is a very good and strong breakout here for McDonald's at the moment. Breaking to new all-time highs, breaking to new highs in terms of relative strength. This is a super strong stock. And look at that tail. That is actually moving very nicely into the leading quadrant after a stint through weakening. And we all know that when a tail does not hit the lagging quadrant and rotates back up to leading, we're actually starting a new up leg in an already rising relative trend, and that's exactly what McDonald's is doing. The next one is Starbucks. Also, look at this relative strength breakout. Very nice relative strength breakout, and here you can see it doesn't really qualify as a head and shoulders pattern, head and shoulders reversal, but it's nevertheless a very nice breakout, and we're looking for potential upside towards 105. This is probably, I put it on because it's a heavyweight in the sector and it's a very well-known stock, but you can already see inside the leading quadrant that the tail is losing relative momentum, and that's what you see right here. Nevertheless, it belongs to the group of stocks that is actually doing very, very well within the consumer discretionary sector. And here is Hilton Worldwide Holdings, and if we put that, highlight that on the RRG, you can see an almost straight line moving into the leading quadrant. On the price chart, Here also a break to new highs in relative strength and breaking from a reversal pattern, at least starting a new series of higher highs and higher lows on the weekly price chart. That is also a good thing. So this also brings Hilton to be one of the better stocks inside the consumer discretionary sector. And then here is TJX Holdings, TJX COS. Very strong break to new highs in terms of relative strength as well as in price. And that is also, you know, a very strong one because it also rotated from weakening back to leading, making it one of the stronger sectors, one of the stronger stocks in the sector. And you can see that move here where the green RS momentum line dipped below 100. That's when it rotated through weakening and then went back up. And that's picking up that little hiccup here, signaling the continuation of that uptrend that's already in place in terms of relative strength. So despite the fact that the big players inside consumer discretionary, Amazon and Tesla, are dragging the sector down, they're dragging the S&P 500 down, there are definitely a few interesting charts within the consumer discretionary sector that you might have a look at for individual stock picks within this sector. And that's it for this week. Thank you for watching. Please remember, Sector Spotlight airs every Tuesday from 10:30 to 11 a.m. Eastern. Looking forward to seeing you again next week for a new episode of Sector Spotlight. Same time, same place.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.